Today, my administration announced that this year, the deficit fell by $1.4 trillion, the largest one-year drop in American history, $1.4 trillion decline in the deficit. Let me repeat that, the largest ever decline in the federal deficit.
If we're going to get a slowdown in earnings, it's probably going to be in Q1 or 2 next year because it doesn't look like it's going to make it this quarter. And as a result, we've got a really perplexing, difficult time for investors.
Politics and sound policies are currently at loggerheads, it seems. The midterm elections are almost here, and there's a lot of activity, especially around the economy, because this has become the most important subject for voters. Inflation remains the elephant in the room. Kevin O'Leary talks sternly about these issues in this episode. Before you dig in, why not click the subscribe button and turn on the notification bell? It would bring you luck. Try it.
Highly unusual situation going on here, given how much the market is corrected, anticipating slowdown in earnings and a recession and a Fed gone wild with another 75 and potentially another 75 after that. None of these rate hikes have affected the consumer yet, and I speculate it's for one singular reason. No economy has ever printed $6.72 trillion in 30 months. That's basically turning on the printing presses, printing money, giving it away for free, dreaming up other reasons to give more money away for free, such as student loan forgiveness, and then the Anti-Inflation Act. That's just hilarious to call it that. It's very inflationary. And so at some point, we'll have to stop printing money, but it hasn't happened yet. All-time record deficit, consumers flush with cash, and these earnings are proving it out this week. If we're going to get a slowdown in earnings, it's probably going to be in Q1 or 2 next year because it doesn't look like it's going to make it this quarter. And as a result, we've got a really perplexing, difficult time for investors.
Mr. O'Leary pegs the U.S. economy woes on the printing of $6.7 trillion in the past 2 years, since COVID-19 hit the country. Despite the markets showing that the economy is in disarray, the U.S. dollar does not agree with the markets. It is detached and has continued to appreciate exponentially in the global foreign exchange, reaching a 20-year peak in September. The dollar continues to be spurred on by the rising interest rate. What investors are paying attention to right now is the U.S. Treasury yields. The 10-year note serves as an indicator for investors' confidence because the treasuries are considered the safest haven when economic situations are unfavorable. If there's a high influx to treasuries, it's a signal that there's no confidence in the other assets market. As O'Leary said, the excess flush of liquidity is a problem, and it seems the recent fiscal policies are driving investors to buying bonds, which is going to reduce the amount of money in circulation. Stock markets may be shrinking, but it is not a reflection of earnings. Corporate earnings are high regardless of their stock pricing.
Well, the inflation fears come from the CPI number, which was over 8%, and that is inflationary. However, there's a new narrative going on in the market with investors regarding how the CPI is constructed. 40% is in shelter, and shelter stats are notoriously long dated. In other words, the numbers you're seeing now reflect the shelter market, the housing market, the apartment rental market 18 months ago when it was smoking hot. That is not the case in major cities now. Rent increases have slowed down, housing prices have softened as mortgages have increased, and yet it's not reflected yet. So it's a little bit of saying, I want to change the data set now because I don't believe it anymore. That's kind of one narrative. But even though it's sitting at over 8%, the market is willing to fibrillate, waiting for more earnings validation that we actually have a slowdown. It's simply not there yet. And so if the Fed keeps using this 8% number and keeps ratcheting rates, they will overshoot.
What he is saying here is, the data used in composing the Consumer Price Index are usually data collected months back before the CPI is released. They're not based on the latest economic situation. Macroeconomist and founder of ARK Investments, Cathie Wood, has also been vocal about the CPI being a misleading index for the Fed to base its current decisions on. Cathie Wood based her argument on the fact that commodity prices have fallen since they peaked earlier in the year. One of the components for the CPI is rent, which Kevin says accounts for 40% of the indexing. Latest CPI placed inflation at 8.2% increase from a year ago. So how did rent fare last month? Rents are actually rising. A previous report on CNBC had correctly predicted that rising rent would place inflation at 0.4% increase month on month, despite food prices going down. The latest CPI report shows a slight slowing down in inflation. CPI may be based on lagging indicators, but has so far reflected the current economy. If this is coincidental, some experts fear, just like Kevin O'Leary, that the Fed may over.
I have another index, Las Vegas, which I've never seen it fuller than it was last week at the Web3 conference. You couldn't walk in the aisles. It was so jam-packed. Casinos jam-packed, restaurants jam-packed, traffic jam-packed. So that pent-up demand is certainly there. Recessions start traditionally with a rise in unemployment. Haven't seen that yet either. If you're in the food services industries on either coast, where in California, for example, the minimum wage is $15, you can't even hire people for $23 an hour now. They don't even want to work. So that cash that's flushing around the system is still having an effect there. It's not clear how the poo-poo hits the fan on this one yet, but the market has made a decision. The corrections in the S&P 500 have been brutal and fast in every single sector. And so the market, generally speaking, is never wrong forever. And what it anticipates is a sharp decline in earnings, because right now the PE, if we believe the earnings for next year, is sitting between 14.5% and 15%. Well, that's getting close to a bottom. I mean, you could argue the bottom would be 12x, which is really, really low earnings for the S&P. But here we are at 15. I mean, I'd argue it's time to start nibbling. You can't guess the bottom, but my goodness, just on a strong index basis, you could go into this market saying to yourself, regardless what the correction is, 2/3 of it's baked in. Well, Biden has to talk his book because he's only weeks away from a midterm where he's threatened right now to lose the House. Nobody knows what's going to happen in the Senate. What they wanted to have happen was that there's some indication of a slowdown in inflation. They didn't get that. And their gas prices in some states are on the rise. That's never, ever good for the incumbent, regardless of what party they're in. Inflation really kills you at midterms, and that's what they've got. So also, if the Fed raises another 75 basis points before, which they will do before the midterms, that's not helpful either.
When rates go up, unemployment goes up. This has not been the case so far, as employment remains really strong. The Dow Jones had forecast unemployment to rise to 3.7%, but in a surprising twist, unemployment had gone down to 3.5%, as 263,000 new jobs were added to the workforce. This means people still have a lot of disposable income, and because of this, we may not see inflation coming down as quickly as the Fed hoped for. On the other hand, the U.S. President Joe Biden is convinced that the country is not likely to go into a recession, or in a worst-case scenario, it would only be a short spell. How long employment remains strong would be a factor of how correctly the Fed measures its next move. Give this video a like before you go, and subscribe so you don't miss out. More hot takes coming soon.